Hi everyone, and welcome back to the College Fund YouTube channel. Before we get started today, remember to subscribe below to make sure you don't miss any of our top college application tips or test prep strategies. And if you find today's video helpful, please go ahead and click the like button below this video and share it with your friends on social media so they can get the advice too. Thanks, and let's get started. Paying for college is a significant concern for most college applicants. For many families, it can even be one of the most stressful parts of college planning. According to CNN, the average American family now pays more than $100,000 out of pocket for a degree from a private four-year college. That can seem like a nearly impossible financial burden for many families, but it's important to remember that financial assistance is available and it's often based on need. In today's video, we're going to discuss just one option for helping to foot the bill, that is student loans. Borrowing money to help pay for college is a tool that many students use to make the college experience possible. But taking out student loans isn't without its risks. If you do your research and make careful decisions about what you're able and willing to take on in terms of loans, you may find out that loans are just what you need to pay for college. In this video, we'll break down the different types of loans available, what to consider before taking out a loan, and also how to choose the right financing options for your family situation. Before we dive into the different types of student loans that are available, let's step back and talk about exactly what a student loan is. Well, a student loan, in the most basic sense, is a sum of money that you borrow to help pay for your college education. Student loans can only be used for educational costs, but that often includes necessary expenses like housing, meal plans, and books. You can check out our blog post, Tuition versus Cost of Attendance, Understanding Your College Expenses, linked in the comments below this video for more details on those alternate expenses. Unlike grant-based financial aid, student loans have to be paid back according to the policies determined by the lender. Your student loan debt will also accumulate interest like most other types of loans. So the total amount you end up repaying over time is more than the amount that you initially borrowed. It's important to understand that taking out student loans represents a major financial commitment. Your repayment plan may last a decade or even more. And while options exist to delay repayment, those options often cause more interest to accumulate and increase your overall cost of the loan. Also, unlike many other forms of debt, student loans can't be discharged even if you declare bankruptcy later in life, and if you have a cosigner, their financial livelihood may be affected as well. The seriousness of the student loan commitment doesn't mean that you shouldn't consider a loan, though. After all, a college education and a bachelor's degree are valuable assets to have. As college costs continue to rise, student loans can be an important financial tool to make college a more feasible option for your family. One silver lining to consider is that making payments on your student loans can help to improve your credit score, which others can use to estimate whether you're reliable in paying off your debt. Many teenagers aren't yet thinking about the complicated notion of credit scores, but these numbers may become really important later on when you're looking for housing, signing up for utilities, or buying a car or your first home. In order to be an informed borrower, you need to do your research and fully understand what you're agreeing to when you sign your promissory note, which is the legal paperwork for your loan. Student loans have both risks and rewards, and there's a lot of variation in the terms of different student loans. So your loan probably won't be the same as your friends or even a classmate's. Obviously, we can't cover all the details of all available loan options here in this video, but we hope that this overview can at least give you a better understanding of the topic of student loans in general, so that when you undertake your own research, which is once again really important, and survey your own loan options, you're able to do so with more confidence and make better decisions. So, moving on, let's take a look at some of the common student loan options that you're likely to encounter once you begin your own research. Within the world of student loans, you're going to find two major categories. Number one is government loans, and number two is private loans. Let's talk first about government loans. Federal student loans. Students who qualify can borrow student loan funds from the federal government, known as direct loans, through the Federal Student Aid Program, which is administered by the United States Department of Education. Student loans offered by the federal government come with certain benefits. Interest rates are typically fixed, meaning that the rate will stay the same over the life of the loan, giving you a really clear idea of how much your loan will cost you over time. You'll also potentially have access to greater flexibility with regard to the repayment process. The flip side of those benefits is that if you fail to pay back your student loans as agreed, the consequences can be especially severe. You could have your wages garnished or your tax refund withheld if your loan payments are not made. You should also be aware that there are two kinds of loans within federal student loans. Those are subsidized and unsubsidized. They differ in how they treat the interest on your loan. If you take out a subsidized loan, the Department of Education will pay off the interest that accumulates on your loan while you're still in school, meaning that that interest during those years will not be added to your overall cost. If you take out an unsubsidized loan, you won't receive that benefit. So your interest will accumulate while you're still in college, while you're still in school, which does add to your overall debt. You may be wondering what determines your eligibility for federal student loans. Well, some factors that impact eligibility are your cost of attending college as calculated by your school and your level of financial need as determined by the FAFSA. The FAFSA is required in order for you to access subsidized loans. There are also yearly and overall limits to how much you can borrow. In addition to federal government loans, some state governments offer their own loan programs. For example, the Massachusetts Educational Financing Authority, or MEFA, is a state authority which offers student loan opportunities to undergraduates who either are legal residents of Massachusetts or are attending college in Massachusetts. Check out the National Association of Student Financial Aid Administrators, the NASFAA website, to find links to resources available through every state. We'll link to that site in our comments below to make it easier for you to find and start your research right away. Each state with a student loan program has different requirements and a different application process to access that program. So once again, you need to do your own research to find out which availability your state might offer. These state loan programs may offer some of the benefits of federal loans, but not necessarily all of them. But remember, government loans are not the only option for student borrowing. Let's move on to the second type of loans, which are private student loans. Private student loans are borrowed from a privately owned source, such as a bank, a credit union, or directly from the college itself. These loans all have their own application procedures and requirements, so it's difficult to make broad statements about them as a category. What we can say is that private loans aren't subject to the same regulations as federal loans, so they're often less borrower-friendly. In general, they are not subsidized, and they offer less flexibility in the repayment process. They're also more likely to come with variable interest rates, meaning that your interest rate may change at some later point in the life of the loan, and that change may result in you owing more money than you anticipated when you signed up for the loan. Another thing to keep in mind is that unlike federal loans, private student loans take your credit history into account. Since most high school students haven't yet had the chance to build up their credit score, that may mean that you'll need a cosigner, such as a parent or another relative, in order to have your loan application accepted. That cosigner will bear some legal responsibility for repaying the loan if you fail to do so, and it can sometimes be challenging to find someone in your life who is willing and capable to take on that role of cosigner. In short, while federal loans are often a better option for college students, they do come with limits and eligibility restrictions, and they just might not meet your individual needs. Private student loans can fill in the gaps and offer more flexibility as you figure out how you and your family are going to finance your education. Another topic to discuss is parent loans for college expenses. So when you research student loans, you may also find information about parent loans that are available for educational expenses. These loans are different from student loans in that they are taken out in your parent's name, not in your own name as the student. Therefore, you, the student, are not the one who is legally responsible for paying that loan back to the lender. We're not going to cover these sorts of loans in detail in this video, but we will say that parent loans may be an option for helping your family to finance your education. As with student loans, you'll need to do careful research and discuss the entire matter of loans with your family. You'll also need to remember that asking your parents to go into debt to pay for your education is, of course, a big deal, and you should take it just as seriously as if you yourself were the borrower. So, now that you know about the different types of student loans that exist, let's look at the process for actually securing one of these loans. Before you even explore taking out student loans, you'll need to be sure that you've exhausted your other financial aid options. Grants and scholarships that don't require repayment are always better options than loans if you are able to access them. But if you are confident that you've fully explored the other funding avenues and still need more help paying for college, it's time to consider student loans and consider applying for one. Since government loans generally have better terms and repayment options, you'll want to start with the Federal Direct Loan Program if you are eligible for it. To apply for both subsidized and unsubsidized loans, you'll need to fill out the FAFSA. Take a quick look at the video How to Fill Out the FAFSA, which is linked in the comments below, to learn more about that specific application process. Deadlines for the FAFSA will vary by state and by school, but it's generally advisable to fill out the FAFSA as soon as possible when it comes out every fall. The FAFSA determines your financial need, which will in turn determine whether you're eligible for subsidized direct loans from the government. The information from your FAFSA will also be forwarded to your schools, which will help to determine how much total direct loan funding you're eligible for based on your calculated cost of attendance that school can come up with. When you receive your financial aid award letter from your college, it will list how much and what type of direct loan funding you'll receive if you attend that school. Because this information is school specific, you won't know ahead of time how much you've been approved for. You won't be required to submit any additional loan applications for these types of loans, although you'll have to attend informational entrance counseling and sign a promissory note or a formal loan agreement before you actually receive your loan. Once you've determined how much you can expect to receive from the federal direct loan program, then it's time to decide whether you need to seek out additional private loans to pay for your education. If you and your family conclude that private loans are the right choice for you, you'll need to start the process of looking for a lender. Remember that you'll probably need a cosigner, so remember to talk this over with your family well in advance and keep them apprised throughout the entire process. There are a lot of different ways to go about seeking private student loans, and there are many different companies that offer and administer those private student loans. You and your family may already have a relationship with a bank or another lender that you or your parents would like you to use for your loans. Your college may also be able to provide you with a list of preferred lenders with whom they frequently work, but ultimately the choice is up to you and your family. You and your parents may want to talk to other families who have sought out private student loans in order to get suggestions. In this day and age, of course, you can even look up reviews and rankings of private lenders online. Keep in mind that your loan's terms will depend on a number of factors that are personal to you specifically, so you may not receive the same loan terms as an online reviewer who recommended that lender. If you apply for a private student loan, you'll have the opportunity to review the lender's offer and potentially compare it to other lenders' offers before you actually commit to signing on to the loan. Later in this video, we'll go over the factors that you'll need to take into account when determining whether any loan, federal or private, is a wise financial move for you or your family. Obviously, the subject of student loans is very complex, and there's far more to the topic than we could possibly cover in just one short video. But to get you started on the right foot, here are a quick summary of the questions that you should ask about any student loan, whether government or private, that you're considering taking on. You should ask, what is the principal or initial amount of the loan? What is the loan's interest rate? In other words, how quickly will it accumulate interest? And also, is that interest rate fixed or variable over time? How much money will you need to pay each month once repayment starts, given a typical repayment plan? How much money will you be expected to pay in total, including interest, given a typical repayment plan? When does repayment start? After graduation, after a grace period, or immediately? Are educational deferments available if you attend graduate or professional school, and what are the conditions of those policies? Are different payment plans available, such as graduated or income-based repayment plans? Will your parents or other relatives be required to co-sign your loan, and are they able and or willing to actually do that? Just like everything else, taking out student loans has pros and it has cons, and a variety of different loan options may be available to you with different risk-benefit profiles. Borrowing money to help pay for your education can help make achieving your goals more possible, but it is a serious commitment and it's up to you to get informed so that you make the wisest possible choice about whether or which student loans are right for you. For more information about paying for college, check out many of our blog posts, which are linked in the comments below this video. Or for more general guidance on applying to college, visit CollegeFind online at app.collegefind.com. That's it for today. Thank you again for visiting our YouTube channel. And if you're applying to college this season and trying to pay for it, good luck.